Good early morning, Dale.
Hey, Kman. So Moses came down from the mountain Friday. And
there were a few Moses around, right?
And then laid down the law. Prices must go down. So definitely was effective and interesting. We're not getting any follow through in euro to the downside.
Yeah.
So is it month end flows, Kay?
It's the Hawks, the ECB Hawks out in force at Jackson Hole, coming out saying that they need big hikes. Most of the Hawks were there and they spoke, and Villarroel, who usually is much less hawkish, let's put it that way, joined the club. So now the market is trying to price near 75 BPs in for ECB next week. So the euro is holding up well versus the dollar and is gaining traction, gaining quite a bit of terrain versus the rest of the currencies. So euro dollar is rather the tool, I'd say, than really the main factor right now. But it is true that 99 is holding rock solid in euro dollar right now.
Yeah, because we came down, couldn't even make a new low here.
No.
Thought we would, and almost everyone's looking for 9. If you read Elliott counts and everything, everyone's looking for 97.5, 98, and this could fool them. We'll see. And the dollar index actually made a marginal new high. Not by a lot. What did we do? The old high was 0.0, and today we got up to 23. So you have a new high in the Dixie and a potential reversal there as well. So I would say I went home saying, "Oh, Dixie's got 110 in it," and now I look at this and it looks like maybe a curveball out here. And go ahead. No, go ahead.
It could be because it not only, well, we're coming out of Jackson Hole, we're creeping out of the hole, but yeah, as I said, the euro is doing better, so that's a big part of the Dixie. But the rest of the dollars is still beat, right?
Yeah, especially yen.
Friday.
Yeah, and yen has not made a new high with the dollar yet. Yields look like they weren't listening to Powell on Friday. They did this, they tried to rally and sold off, and then they gapped up here. I think they actually made a new high, but look at this.
The market needed a bit of time to digest what is a very short speech from Powell, and just to say that they will just continue to do what they are doing, and it must have surprised a few. But now, yes, we are firmly back above 3%, which is one of the reasons why dollar yen is up here. The other one being that Kuroda was the only dove in the hole and sent the yen spiraling lower versus everything.
Okay. Ryan around, what are you thinking?
No, it's a bank holiday in the UK, so he's having a bit of family time.
So
you're in the UK as well, though, right? Why are you not on holiday?
Because I'm an addict.
And we're missing Ryan and Blake today.
Yeah, I know Blake saw the Killers last night.
Killers.
So
I hope they didn't kill him.
Yeah. So Stel, any reaction to Powell? I think you thought that we might be getting closer to him talking about a pause. He sounded the opposite, right?
Yeah, but I have to say, I thought that with inflation kind of giving us a couple of, I don't want to say weak, but not strong prints, maybe he could have put in there some kind of a slightly dovish comment. He was not dovish. I mean, he was not dovish by any means, I don't think. And he said that they're going to keep going until inflation is in check. And the thing that I think was important that he said was that they have to be wary of switching back to accommodative stance too soon. So it's I think given the circumstances, it's probably as hawkish as it could have been.
Yeah.
And that's what the markets acknowledged after a few minutes of, I don't know what that was. Markets were down quite a bit on Friday. Yields going higher, not convincingly higher, but still rising a little bit. Actually, let me take the screen for a bit, and then maybe we'll have somebody else pick up. So I look at yields first thing when I wake up in the morning, and we had a move higher in yields, but it's been, I thought, if you had told me what Powell said on Friday, if you had told me in advance, I would have told you, look, I think we're going to be breaking well higher in yields, and we're not. So that's food for thought. The bond markets are not quite yet acknowledging the possibility of the Fed just, they keep going hard, and we are pricing between 50 and 75, closer to 75 now for the next meeting. I think 68, 69 points, close to 70 now, basis points. So the market is expecting broadly a 75 next meeting and more after that. So, 75 will take us well below 3%, and then we'll be on our way to 4. So, I would have thought that bond yields would have broken out. They haven't yet. Actually,
the T-bonds put in a solid up day. And if you look at like TLT or any of the longer durations or T-bonds, they had a very good day, putting in a higher low. It's not exactly symmetrical with the left shoulder, but bonds put in a good day, a good week.
Left. Yeah. Okay. Could be. Yeah. I mean, they're down today. This is down today on pre-market, but yeah, I mean, it's still not convincing. That's the thing with yields. I'm not totally convinced yet. Stocks, on the other hand, we had a pretty powerful move lower. Look, today we've touched the 50 DMA, and we've kind of bounced off. I mean, it's incredible how these things can work. These technical indicators can often work, and even the highest. Not the 50 DMA, the 200. Look at this. I mean, this was perfect. Just went above. You say, Dale, so correctly all the time. You have to give it some breathing space. If you had put your stops right on the 200, you would have been stopped out. It went just marginally above, and it's back down again. So this worked really well. And the 50 is capping it on the downside. Obviously, it could break down, of course, but the first reaction usually is technical, and it's worked so well here. Anyway, bottom line is that stocks are lower, quite a bit lower on Friday. They're lower again today. So the market is kind of fearing higher yields. I have some friends I talk to every day. We go to the gym together. I think I've mentioned them before. They're ship owners, and they're very clued up, but they're not traders. And they're like, shouldn't it be that when things are going well and the Fed is raising rates and all that the economy is doing well, so stocks go well? I said, well, you know what? It used to be the old normal. Obviously, excessive tightening will be bad for the economy, but we're nowhere near that yet. And I said the new normal since 2008 is that, zero rates and QE means cheap money, cheap financing, cheap borrowing, everything. So everything goes higher. So now that the punch bowl is being taken away, it's only natural that things reverse.
Speaking of boats, I saw a piece by a guy who lives in Southern California. There's a fire sale on boats. Newport Beach is a real nice area, and very expensive slips, and boats have been discounted 50%.
Wow.
In the last 6 months because of fuel costs and everything else. People are dumping them.
Yeah. And you will see this, people selling things when they need to raise cash. Even the car market now, the used car market. Remember how it was ridiculously expensive because of the difficulty to get parts for new cars, right? The production was difficult, so secondhand cars were going up. Well, now even that's turning. So because when the consumer doesn't have money to spend, it doesn't matter how not any. I don't mean it doesn't matter, but if there is a difficulty in producing the cars, but the demand goes down faster, then obviously the price of used cars is going to go down. So even that is coming down. And I think the main theme is disposable income. It's disappearing everywhere, especially in Europe. With energy prices where they are, they're going to be raising rates here, energy rates, I mean, in Greece, the 1st of September. Everybody's scared to see where it's going to go. It's crazy. We heat our house with natural gas. We used to have an oil burning, with oil, but now we changed it a few years ago, and now gas has gone up 10 times. So we're thinking, we're going to be using a little bit less this winter than last winter. But anyway, the
Can
bottom
you
line,
change it back?
Yeah, it's
Are
difficult.
people changing it back?
It's difficult because it's different equipment.
Piping.
It's different, different equipment, different everything.
It's
so you can't really change
expensive.
it. But anyway, bottom line is disposable income is going down. People will not have money to spend. They will only be spending on the necessities. So you can expect a lot of things like you said, boats and cars and all that. It's going to be going down. Plus, you have the crypto bros who are selling the Rolexes, and everything is coming back to earth, which is not a bad thing. Property, I think, is going to be, from what I read in the States and Canada, actually not yet, but States already, there's more supply out there. Long end rates are more expensive, they're higher. So to borrow for 30 years is a lot more expensive than it used to be. Refinancing is difficult. So you see more inventory coming to the market, which means that houses come down, which is logical because they've been going up at a ridiculous pace, and it's an opportunity for first-time buyers to get in the ladder, and for people to upgrade and all that. So anyway,
Do you have any levels for gold and silver that you're interested in?
I've been looking at silver. I talked about it before. This is a very obvious level, 1813, wherever that low was. If you want to play against that level, I think it's not a bad idea. But the whole sentiment and the way things have gone, I'm not touching it yet. I want to see more price action. I will get long again, but I'm not touching it just yet. If we break below and we then close back up, I think that will be a nice signal to get long. But I'm not touching it. If we get really close to the level, I might take a long, really close to it, but for a short-term trade, with stops below. But for my long-term kind of full-size trades, I'm not looking at that. I'm not touching it yet. Gold is trading a little bit better. I mean, it's still in a sideways consolidation. It's trading a lot better than silver for the past few years. And if you look at the big picture, it's still an impulsive move higher and then of grinding sideways. Yes, we do have quite a bit of up and down, but it's still sideways. So given everything that's happened with yields, with inflation, obviously gold is supposed to be an inflation hedge, and it is inflation hedge, but in the short term, rising yields and rising dollar will kill gold, and gold is actually doing very well. So it is trading a lot better. I am definitely going to try and take along if we get close to these lows, 1680. We talked about them for ages and ages. Again, not as a long-term trade as I usually do, just as a short-term punt. But it's not looking good at the moment, so I'm staying out. And the Dixie, you did talk about it, and we did make a high. We're back down now below, so we took out those highs. We're back below. I want to see more price action. It's not an easy one to call yet, but look at this daily candle. It doesn't look
Yeah.
good at the moment. It really doesn't. The one I really like, and I've talked about this for a while, is Euro Pound. I still think we're going towards the 90s because, as I said before, I think the euro will strengthen due to the ECB becoming more hawkish. I'm not saying that the Eurozone is a nice place and the economy is going to do great. I don't think so. But I think based on policy divergence, we're going to see the euro performing better than the pound. And the pound, again, I'm going to repeat, I find very, very few reasons to be bullish the pound against anything. There's so many things that are so much uncertainty, not just political and domestic, but in general, the UK economy is not doing well. I'm not saying that other economies are doing great, but it's underperforming. So and there have been times. Remember when I was very bullish the pound when Brexit happened? I said, look, I think the next 6 months are going to be good, and they were great. But now is not the time to bullish the pound, in my opinion. The time will come, but it's not yet.
Okay.
Anyway, just a few pointers. Actually, this is probably worth looking at as well. Bitcoin, we've been talking about. It was hugging this support trend line in the channel while it broke below, and now we're in this zone, which really the next level is those low 17 something. If that goes, then good night. The last person out the door, turn off the lights, and we all go home. But okay. There is support near this 20,000 level. There are buyers, but cryptos are up today, but it doesn't look good. I mean, technically, if you look at this chart, there's just nothing to feel good about it.
There might be buyers, but I think we have more sellers, Celio. It's more than obvious.
I don't know. Yeah, it looks like it, but yeah. Anyway.
Okay. Hi, Steve. How are you, buddy?
Hey, Dale. Good morning, mate.
Good morning, bro. What your reaction to Powell and the market's response?
I think things are quite easy. In this case, there was no possibility of, having different reads on what happened. I think that Powell quite directly shot down all the expectations of an ultra fast Fed pivot, right? In essence, he shot down one by one all the hopes of the bulls. I had said in advance that, in my opinion, the charts looked like the path of least resistance was higher for the dollar and lower for equities from where we were. And, purely technically speaking, I would have chosen that direction because, of course, you can never guess what somebody's going to say. My expectation was that the Fed is not going to pivot that fast, but you still cannot be sure, right? But in any case, I think Powell was very, very clear, right? We're nowhere near at the moment, although these things can change rather quickly, of a Fed pivot. And I think now the markets have literally had a rug pull because all the hopes they had for the time being are just removed. So I strongly believe that there is a huge possibility of, a very decent follow through. I don't see any reason why the markets would forget about it tomorrow, the day after, and start being super optimistic once again.
Okay. You want to show your charts and anything you want to?
Isn't Blake gonna?
Blake's
He's not here today.
off today.
Oh?
Yeah, we're missing Blake and Ryan.
Oh, okay, sure. I can.
Hey guys.
Grega's
the
here.
wizard's here. There we go.
Yeah, I'm listening.
How have you been,
Go
Grega?
ahead. Go ahead and Grega take over and no, you do your homework over the. Oh, that's right. You had surgery. Did you have surgery?
Yeah, on Friday, yeah.
Okay.
But it was a small surgery, so nurses were
removing
fine.
your testicles finally.
Come on. Come on.
Steve had to do that one. He just had to, right, Steve?
He always does that, yeah.
It's hard to trade without them.
I would seriously consider it if I had a second child, because then you have a huge possibility of a really bad accident.
Well, you don't have to go be that extreme to prevent that, Steve.
I'm joking,
in
of
case
course.
you haven't learned that. Okay. You don't have to become a eunuch. So anyway, Grega.
So Grega, I think we had agreed on the possibility of the markets continuing lower, having to do with equities. And I think we're seeing a very impulsive follow through. So I'm pretty sure I know what you're thinking about it. Do you think that the correlation with the dollar is going to remain and keep on, in essence, grinding higher for the dollar as well? What do you think? I think we will for the time being.
Well, I think that US dollar is now obviously it hits a new high, if I'm not wrong. Euro dollar still was managed to stay above that low.
It did.
However, I think that this could be some late stages of an impulsive reaction. If you look here on the US dollar, just a second, you will actually see that I'm tracking a higher degree fifth wave, which can be coming into some late stages here. Of course, there is room for 110, 111, but generally speaking, I think it's a fifth wave here. So if the question is how the US dollar will maybe react to non-farm payrolls report, if maybe the sentiment will change, and if we see weakness on the US dollar, then I think that maybe we will have some evidences of reversals, and this could be triggering supports on stocks. But when looking at the stock market here, the important is this invalidation level of a bullish structure. Okay, so despite the current sell-off, we still have only 3 waves to the downside. Last week we talked with Blake that we were looking for this only temporary wave B rally and then a sell-off. So now we have this wave C. But if we think that this is a wave 4, then price should not make an overlap with the wave 1. So you're now at a very key level. So
and we're probably building another bearish pennant here in the short term, right? I mean, the very short term price action here looks to me like,
but I will leave this market to decide. I mean, I don't have real bias, strong conviction at this moment, but I know what I will look for if I see a rally from here without overlap, and then let's say that we go back towards 4,200, then I would be looking for a new high for a fifth wave. If we see an overlap, then I know what this means. Probably we are going to attack the lows here back from June, and this could be triggering much more upside.
Where's that, under 39.5?
Yeah, that's the key level. So as I said, I'm neutral now. I'm just waiting on market to confirm if this is a wave 4, or maybe make an overlap and then we look for a bearish picture. So if
although technically I agree 100% with all the comments you made, fundamentally speaking, I lean more towards the possibility of more downside, because as I said, in my opinion, Powell was very, very, very hawkish in comparison to market expectations. Yeah, and that is not an easy pill for the market to swallow.
Yeah, but what if suddenly we get very bad numbers on Friday?
Yeah, you know something? It depends, because it depends. I'll explain why. Because if Powell being quite clear that they're not basing a potential policy reversal on just, a few inflation numbers that show, marginal improvement, etc., stands, I can make the argument that worsening economic data is going to be even worse for equities, right? Because what happens if equities start believing that the Fed will need a lot of bad data to pivot, right? It means that worsening economic data is even worse for the stock market until the Fed actually pivots. right? Because bad data is good data when you believe that it's a matter of, you know, very little thought for the Fed to go back in quantitative easing, slashing rates back to zero, so on and so forth. But I think it's more than obvious that the Fed is not willing to do that yet. I'm not saying that when things go really bad, they won't, but I'm saying that this time around, it's not as easy as it used to be in the past.
Yeah, good point. Well,
Okay.
if we see this 3950, as you said, then obviously this could open room for more weakness. In such case, I would bring on this wave count, which shows that there is room for a retest of the June lows, as I said, and then maybe we try to stabilize later this year. So obviously, if we get this overlap, you know, the decline could be very.
So then it's a more
quick
complex correction lower. I mean, we've had a complex wave A down, right?
Yes, but normally when you have one first leg, very choppy overlapping like this one,
You have a more
then
impulsive C.
very strong one drop,
Yeah.
yes, could be much more visible and clear, meaning much more sharper sell-off could be seen in wave C. So that's why I'm saying that this, for me, is very important 3950. So if this one holds, as I said, and if we rally, then I think that US dollar index will stop at the current resistance levels and even sell off, which would be quite interesting because we already managed to reach a new high on US dollar index. But for
Grega,
now,
I was impressed with the bond action Friday, with them talking so hawkish. The long end of the market did pretty well and actually finished higher on the day, putting in higher lows, something I talked about with Stel earlier. So there's the 10-year, the 30-year, the further you go out, the better the market acted. So 30-year, the 10-year, yeah, it looks like that still could be maybe some kind of
I mean,
right.
10-year
but if you look at a 20 or 30-year, it looks better.
I don't know if I have it here. Here is, no, that's 2-year.
Year.
This one. These are the yields, obviously.
Okay, yeah, that's still the 10-year. Yeah. So can this be a B?
I mean, I'm not with current dollar strength. I really am not that sure. I mean, I think when I'm looking at this at the 10-year, just to give you the general view, I think that we are going to see this retest of these June lows. Yeah.
Okay.
So this is somehow more leaning towards risk off, like maybe like Steve described. So we'll see how this unfolds. But I really think that any risk on trades, at least it's too soon for me. But if we see that rally as it's described in the S&P 500, then I'm ready for it. I'm even commodity currencies looks very weak and very hard to follow on the long side with any kind of a setup at this stage, in my opinion.
You mean like the Aussies holding up great, and
yeah,
you know,
and
the
Canadian,
yeah. Okay.
Yeah, if we look at Kiwi, I mean, price action there is.
And the NOK didn't rally as much as you know, other dollar pairs. It still looks you know, weak to me as well. Stel's favorite.
I mean, here, since I mentioned Kiwi, you can clearly see that there was a very nice free wave rally. And now we are just selling off, breaking some important swing supports here. So I think that this is a very nice resistance at 6,200. So watching for potential more weakness after this wave B could turn a little bit more complex. But overall, again, as I said, on US dollar index, I see final stages of a higher degree fifth wave, but unfortunately cannot say that we are ready to top yet. And here as well, I'm tracking a very big wedge formation, maybe a retest of these 2020 lows and then potential stabilization sometime later this year.
Okay. All right.
Did we,
well, it's
Did we talk about crude oil? Anything?
No, go ahead. We have a minute. Carley, my guest is here. Our guest is here. So yeah, why don't you wrap it with crude?
Grega, I'm a little bit torn. I think that crude might have already broken higher, although for extra confirmation, I want to see a daily close above the 200 daily moving average at 96.80.
Yeah.
What are you looking for?
Yeah, for now, I like the price action and this wedge formation. I mean, we came very nicely to the upside. Then it looks like this $95 per barrel is a key resistance. If we can close above that, then I think that we go higher. We will have even stronger conviction that support is in place here and that this could maybe produce more upside. But at least for now, the commodity currencies are not holding any good correlation with the crude oil. So it will be quite tricky this week, in my opinion.
Are you long a lot of Alice?
Excuse me?
Sorry, what did you say?
Are you long a lot of Alice? I see your crypto search there. You're looking at Alice.
Okay.
All of those things.
Yeah, that's a symbolist. Yeah.
Yeah, all right.
I didn't even know such a thing existed. That's why
Ambrosis.
Yeah,
you knew that one,
I
right, Steve?
also didn't.
It's like the song goes, Alice, Alice, who the hell is Alice? Not who the hell, you know.
I mean, better to close the crypto list for now because the sentiment there is just awful.
Yeah.
And to be honest, the charts look horrible as well, Grega.
Yeah, and everything it has to do with the US dollar. So cryptos are probably the last on the list to look for when you have this strong dollar.
Good thing that at some point the selling point was that it was they were uncorrelated assets, right?
Yeah.
Yep.
Uncorrelated to sustaining a bubble. All right, well, guys, thank you very much.
Thank you, Dale.
Good job stepping up. Appreciate you being here, Grega. Hope
Thank you,
that
Grega.
knee heals quickly. Thank you, Stel.
Thank you, mate.
Stel, I put the list together without a cup of coffee. Steve, always great to have you in here. And, good, nice session and appreciate it, team. And thank you, Kman, for not taking advantage of a bank holiday. So, you are a dedicated showman because the show must always go on.
Exactly.
And thank you, Coach, for being here day in, day out, doing the absolute, best show on the net by a mile.
Thank you, Stel. It's not me, it's my clone now. It's been doing it the last couple of years. So I appreciate it though, buddy. Thanks, you.
Man.
All right. Carley, welcome back to F.A.C.E. Great to have you here.
Thanks, Dale. Good morning.
It's amazing how the time flies,
Doesn't
when you schedule your next appearance and it's 3-4 months away and before you know it, here you are again.
I know, you're exactly right. I was just thinking that this morning.
So you always have real nice technical stuff. You want to share your screen and maybe you could start off telling us about the Moses effect, who I'm calling Powell Moses, coming down from the mountain, laying down the commandment of there must be lower prices. Anything you want to fade? Okay, interesting. Okay. We're using the same term in the dollar. One more last hurrah.
Mm-hmm.
Do you think we did it today?
You know what? You know how it is trying to pick tops and bottoms. It's a tough game. So. Yeah. I think we've got two levels that we actually wrote about this for our clients and for real money last week.
Okay.
Either the dollar is putting in some sort of, this is our best guess. I mean, obviously we can't see the future, but either the dollar is putting in some sort of a double top here, or if some unforeseen news comes out, which I'm not expecting, but it's possible if something surprises the market. Yep. I mean, we could get one more big last hurrah up to somewhere, this is on the futures, somewhere around like 113 or so 113 and a half. I'm not expecting that, but anyone that's following the stuff should understand that's definitely possible. Markets can do weird things, but you notice when the dollar tops out, it tends to be pretty dramatic. I mean, here's March 2020. If we go back into some of the other, like 2016, it doesn't just slowly roll over. It's usually some sort of a dramatic top. And this, I think, could qualify. I mean, the rally that we saw in July was almost parabolic, and then we saw some pretty sharp moves last couple of weeks. So
and the momentum, you're getting divergence at this new high.
Correct. This is ironically, this is almost exactly what we saw in natural gas a couple of I guess it was probably several weeks ago at this point. I'm not saying
when they had the fires at the end, and that gas went down sharply.
Correct. It went from like $10 to $5. Now, I'm not saying the dollar is going to cut in half, of course, but we could easily see 97 somewhere in there. That would be following a long-term. You can see this kind of a long-term pivot line. So moving averages come in here. This is a weekly chart, by the way. So it's definitely not impossible for the dollar to reach 97. I know very few people are looking for that sort of thing, but the reality is, if you look at sentiment readings, we look at like the COT report and a lot of the consensus, like basically polling that shows who's bearish and who's bullish. And it's almost the exact mirror image today as it was when the dollar was bottoming out in 2021 right here. If you kind of rewind to 2021 when the dollar was like breaking below 90, literally nobody thought the dollar could not let alone rally. Nobody thought it could avoid some sort of Armageddon because the Fed was printing money. I mean, there was all these bearish stories, and now we're kind of at the opposite. It's kind of hard to find a bullish story. A bearish story on the dollar. Everything is bullish, which is could be a sign that things are turning the other way. And this divergence is a really big telltale sign. I mean, there's no guarantees, but when you see this sort of dramatic RSI disconnect from the futures contract, it's usually a precursor to some sort of reversal. So
I'll give you another piece for your case that you're building here.
Okay.
Euro in positioning commitment of traders has the largest net short position since February 2020, and that was just prior to a pretty big move in the euro and a pretty big decline.
I agree with you 100%.
So,
absolutely.
Yeah, so I mean, the way it's people are positioned right now, does kind of look like that. So, okay, great look. So here, do you want to talk about the euro, or are you gonna?
Yeah, so I mean, it's the same general idea, but I'll just point out a few things. Again, remember, like when everybody's thinking the exact same thing is usually when the opposite happens. I remember in 2006, 2007, literally people were refusing to be paid in US dollars. They wanted to be paid in euros. And that's like the euros hasn't seen $1.60. And at this point, we're kind of in the opposite situation where everybody wants dollars. The world can't get enough. That's going to change, and it changes quickly. And as you mentioned, everybody's short the euro, long the dollar. It's actually the one overcrowded trade this year that has not corrected itself. So if you look at earlier in the year, the overcrowded trades were long crude oil, short treasuries, and long the dollar, or I should say long commodities, not just crude oil. The commodities have mostly unwound themselves, not all the way. Treasuries partly unwound, and then now it's giving some of that back. But I honestly think treasuries will have a round trip and go back to where we started before the war. And jury's out on the currency market, but I think it probably will. I mean,
You're
if we had
constructive on treasuries.
I am. Yeah, let's take a look at the chart there.
Because I looked at I use a TLT as a proxy, and this is what 10-year. This is a note.
This is the 10-year note future. It's the weekly chart. Now, if you're familiar with futures, obviously the contracts expire. So anytime you're looking at weekly or monthlies, it means the data from expiring contracts is kind of meshed together, and all I'm saying is it's not, these types of charts aren't perfect. You have to be careful because the compute basically the algos are filling in data.
You have to be careful, period.
Yeah, Well, there you go. Exactly.
Yeah.
But here's kind of what I see in treasuries. I mean, to be honest, I'm a little surprised they slid as much as they did here in the last couple of weeks, but this has just been a wildly volatile market. And so it's not that unexpected to see some things get out of hand. But we're seeing the same type of RSI divergence, not quite. I mean, we haven't made a new low here, but it looks like it's there's a little bit of upsloping in the RSI, which I think is interesting. But to me, this looks like a reverse head and shoulders. So we're kind of forming the second shoulder, and we'll see how it goes. I personally think a couple things that are happening this week that most people may not have on their radar is the September futures are going into expiration. First notice day is Wednesday. So a lot of this selling that we're seeing here in the last couple of days, I mean, obviously there's all kinds of stuff going on with the Fed.
They're rolling them.
Right. So a lot of times when you, don't ask me why or how or why it just happens over and over, but usually, not usually, but more often than not, I'll say, when a contract's going into expiration, you often see a really big spike in price in whatever the direction the trend is at that point. And then once we get past expiration and everyone's rolled, it tends to go the other way. And so I think that's probably what's going on here. I think everything's just being exaggerated and pulled down by those rolling. I mean, if you can, and a lot of it has to do with human nature. People that are trapped on the wrong side of a trade want to wait to the very last minute to get out. And so that tends to be exactly.
I just want to get even.
Yes, there you go. That's exactly.
And then in your head?
Yeah, exactly. And then and then what happens is they get squeezed out. Like, a couple weeks ago, they were like, well, I'm long, I'm wrong, but I've got some time. And then next thing you know, they're really motivated to exit at crappy prices because they're out of time and they can't take it anymore and that sort of thing. So that happens a lot. So we'll see how it goes, but I actually think we are going to probably hold current levels, maybe slightly below. And then I think we've got a pretty big rally ahead of us in treasuries, believe it or not. It's another situation where everybody's thinking one thing. And 3.5% on a 10-year yield is better than what we've seen in a long time. And I think people are going to find that with the uncertain stock market, volatility all over the place, it's not such a bad idea to have some in your portfolio. And a lot of people wiped it out of their portfolio earlier in the year. So I think they're going to allocate that back, and that should put us, stabilize us at least, and hopefully put us much higher.
Yeah, I have a similar chart in the TLT, which is 20 years in duration. And where you have the black line coming in at 130, I have a similar line on TLT, and it could rally back to 131, though, TLT, if I just do a measured move on head and shoulders. So
correct.
That's one heck of a rally. And I have to think that I don't know, is it going to be risk off, or I don't know what's going to be behind it.
Well, that's an interesting story. This is probably a little counterintuitive, but I actually think if you look at, this is about when war broke out somewhere, it was about in this area. Had we not had the war situation and the inflation scare and all that kind of stuff, we probably wouldn't have seen this size of a move. I'm not saying we wouldn't have sold off, but it wouldn't have been this wild. I think just mean reversion kind of puts us back towards 130. But to be honest, I think we get a little bit of a melt up. Like the Fed's tightening, they're pulling money out. We've got QT going on, quantitative tightening. But if you look at the money supply, it's still really, really high, and people have to put their money somewhere. And so if we start getting some stabilization and inflation, I think what happens is we could get a melt up in risk assets. Let's just say stocks and bonds at the same time. I mean, they went down together. They could very easily go up together if inflation kind of levels off. So.
Okay. Wow. You covered a lot of ground in 15 minutes.
Well, I try.
So if there aren't any other instruments you want to cover, are there any?
It's up to you. I mean, another thing that we've got our eye on is grains. I don't know if there's any grain traders here, but this is a daily chart of corn. It's kind of the same.
Good.
Yeah, they look good. Honestly, I really have serious doubts about this rally, though. I think you see there's like a trend line here. So even if we go another 20, 30 cents, which is possible, I think it rolls over. This is the September contract in corn, which is also going off the board. I have a feeling we may kind of spike up a little possibly and then roll back over. Simply because everybody wants to be long corn because it's worked the last 2 years. Everyone, the commodity, inflation, trade, all that kind of stuff. But
yeah,
it would take a big fundamental surprise, in my opinion, to get much higher than where we are, simply because the market, for some reason, the grain market has kind of ignored the fact that the dollar's at a 20-year high. Normally, when you'd see the dollar this high, grain prices would be under pressure, and that hasn't really been the case, at least to the magnitude that it probably should be. And so in March, before all of the inflation trade money came in, which is what happened here, everybody just started buying commodities blindly.
Wheat,
Yeah,
especially grains because of Ukraine, right?
Exactly. And so all of this speculative money came in right here, or inflation hedge money, whatever you want to call it. And that's been pulled out of the market. And now we're right back where we started from. But in March, before all that inflation money came in, these were considered very high prices. $6.50, $7 was really high. And now, for some reason, because we saw these $8 levels, we think, people are thinking this is cheap, and it's really not cheap. It's actually very expensive. And so I have a feeling this rally has a tough time getting much above where we are.
You and I remember $2-3 corn.
Exactly. Yeah.
And $5 for $5 wheat and $8 beans.
Right. The problem is, this is a monthly chart. Farmers are just they're too good at what they do. And as technology gets better every year, they get better and better. So this is what we did for almost a decade. We traded between $3 and $4. Honestly, I think we probably lifted the bar a little bit. I don't think $3 corn is something we'll see anytime soon, but $5 corn, absolutely. Sure.
Okay.
Yeah.
4.50
to, yep, exactly.
Well, you have a great feel for markets across the board. And I know some of it's fundamental from being in the business for a while. It's not just all charts when Carley is talking, because she looks at, the other side, just knowing grain history and knowing that farmers can, they're the bravest souls in the world as far as
they really are. Tough business.
They make a commodity trader look like a picnic. So, Carley, your work is great. I know you specialize in options on futures, and I'm sure there's some people in this volatility that, if they want to trade something outside of FX, they would need a good guide for trading options, because sometimes options aren't, it's not great to buy them when they're real puffed up, and you have to maybe spread them and take in some premium. What's the best way for people to learn from you and get in touch with you if they're interested in this kind of trading?
So if you're interested in commodities and commodity options, you can visit our website. It's decarleytrading.com, DECAR.
Want to show it?
Sure, let's do that. Okay, let's do it.
And also, Carley's work, she talks about where her stuff is published. She's one of Kramer's favorites when it comes to commodity markets. He features her work quite a lot.
Thank you. Yeah, he's good to us.
Yeah. So there it is.
Yep. So decarleytrading.com, and there's a lot of free educational material. If you just see on the top, you see there's a learn column, and you can watch literally like 45, 50 videos. It's all free. We're a brokerage service. That's how we make our living. We make our living off commission, but we want to make sure that clients, number one, know what they're getting into before they ever put their money on the line. And number two, an educated client's a better client. So we try to teach everybody. And if you're interested in books, I've written several books. If you're interested in commodity options, I've written a book. It's called Trading Commodity Options with Creativity, and it covers everything from base level ground zero to some pretty complex option strategies and how to hedge if you're wrong and adjust if you're wrong or right, that sort of thing.
Okay, well, thank you so much. Great to talk to you again, Carley. And every time you come, great looks and narratives and ideas to consider. And You are my trading warrior sister, and we appreciate you here at ForexAnalytix.
Thank you for having me. I appreciate it.
All right, and we'll talk again in the winter.
Absolutely.
And it'll be here before you know it. It's like a game of winter is coming, which I'm
Right.
looking forward to because it's going to be 105 all week here where I live in California. So winter couldn't come soon enough for me, Carley.
I hear you. Same in Vegas.
Except when I lived in Chicago my whole life.
Yeah.
You know, except for playing hockey, I could live without it. In fact, that's why I moved to California. I asked my mom, why did we settle here? Because I'm watching the Rose Bowl with 3 inches of ice on my window, and I'm seeing people with their shirts off getting a suntan in January. So anyway,
legit question. That was a legit question.
So at 22, I packed my car and headed to the coast. So
perfect.
Anyway, great talking to you.
Thank you.
And have a great fall trading season and look forward to our next conversation.
Appreciate it. Thanks a lot, Dale.
All right. Carley Gardner, everybody. Thank you. And you could join the team in 25 minutes for the morning edge. You're welcome, Steve, Ingmar, Laura. Okay, everyone appreciated what you had to say. Thank you very much, Carley. And remember, don't just count your ears of corn, your pods of soybeans. Count your blessings. See everyone tomorrow. Adios.